US inflation comes in hot even as Trump ups his tariff game. RBI gets a gift from India's CPI print, and Goldman Sachs marks its return to the show. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We're back on our usual time of Sunday, 7 p.m. as promised. Luckily, there were no immediate assignments or urgent or for unforeseen assignments coming my way. So we're back in our usual time and hope to keep it that way going forward. Right. So where do we start? Lots to talk today. So you would think, let me just put a question out there to start off with. Yeah. You would think, if I were to tell you, yeah, you had a week in the US markets where President Trump ratcheted up his tariff plans, inflation came in hotter than expected. What would you tell me? You'd tell me, Vinay, essentially, what's going to happen is essentially the markets would tank, right? You basically say US markets had a completely bad week, a week to forget, so on and so forth, right? Wrong. The exact opposite is what transpired, as actually all three indices ended the week significantly higher. Now, there is a reason for this. There are multiple reasons for this, actually. But before I go into the reasons and before I take you through what transpired in the week gone by, let me give you a little quick market snapshot. Once the dust settled, all three indices ended up firmly in the green. Dow added 0.5%, S&P 500 jumped 1.5%, and the tech-heavy Nasdaq jumped a whopping 2.6%. So, ladies and gentlemen, without further ado, let me welcome you to the Doctor's Weekly Snapshot first. And before I explain to you why markets reacted in a way that defied conventional wisdom, by the way, your answer is, the answer to the hypothetical question that I posed to you would have been right based on conventional wisdom. However, markets tend to do something different all the time. They have the tendency to surprise us, right? So before I tell you why markets reacted in a way that defied conventional wisdom, let me take you through the first major economic data point that we received last week, which was the Wednesday's CPI print, the January CPI report in the US. Consumer prices increased by 0.5% in January, marking the largest monthly rise since August 2023 and surpassing surpassing economists' expectations of 0.3%. So there was a 0.5% month-over-month rise. Economists were expecting 0.3%, so clearly a big difference there, not in a good way. Over the past year, inflation, if you take a year-over-year basis, inflation rose to 3% up 3% year-over-year in January. It was 2.9% in December. So again, wrong direction. Hotter inflation is not what we want. Excluding volatile food and energy prices, core inflation climbed by 0.4% month over month, the highest in nearly 2 years, and reached 3.3% on a year-over-year basis. So nothing about the January inflation print in terms of numbers was good for the markets. So what drove the increase? You had higher prices for used cars, higher prices for auto insurance. Guess, believe it or not, because bird flu outbreak, you have egg prices that are also contributing to inflation. In fact, egg prices jumped 15% on a year-over-year basis and were one of the primary contributors or primary drivers behind the hotter than expected CPI print. I never thought I would say this. Yeah, I never thought. A lot of things normally it's, within food prices, vegetable prices, again, never thought in the US eggs would be a big problem. In fact, there were restaurants that actually said, we're going to charge you more for egg dishes on breakfast and so on. So something crazy is transpiring when it comes to eggs. But, the restaurant price increases make sense given the fact that the commodity egg prices was one of the primary drivers of January inflation print. Again, never thought I would say this, but hey, this is what markets are. They always bring up one surprise or the other, sometimes for the good, sometimes for the bad. Unlike previous months, housing and rental costs were not the primary drivers. However, I would keep the champagne bottle on ice. Yeah, I wouldn't be celebrating too much about the housing and rental costs. And this is because a surge in apartment construction during 2023-24, especially in cities like Austin and Phoenix, had led to an oversupply and falling rents. And this is why you're seeing that in January, the rental prices or the housing prices or house prices were not primary contributors to the inflation print. That is likely to change, by the way, because with high mortgage rates making home ownership unaffordable, demand for rentals is actually increasing, according to a very recent article that was published in the Wall Street Journal. New construction is also slowing, adding to the problem. This is expected to create a landlord-friendly environment with rising rents by the late 2025. While shelter inflation, like I said, while housing prices and rental prices were not contributors to the January print, while shelter inflation slowed to 4.4% in January, and this was the lowest since Jan 2022, higher rents, the rents in some areas have already gone up. Higher rents could actually reverse the trend, pressuring and putting a massive pressure on inflation. So we already have eggs and auto insurance doing it. We were thankful that the housing prices and rental costs were not contributing as much because the inflation would have been worse, but this is likely to change, and we will have to see going forward how it is going to transpire. And as such, I would be keeping the champagne on. I would keep the champagne on ice. Wouldn't pop the champagne bottle yet when it comes to housing prices. Now, the latest inflation report also doesn't factor in President Trump's recent tariffs on Chinese imports. At the same time, the January price hikes reflect businesses adjusting prices at the start of the year to account for rising costs. This trend, right, of businesses basically rising their prices at the early of the year has been it's a very recent trend, and it kind of makes inflation in January quite unpredictable. So on one hand, you have an inflationary pressure whereby President Trump's tariffs on China have not been factored in. So once they factor in, they're expected to drive inflation prices. But on the other, you could basically say it could be a January effect, right? It could very well be this recent trend that the companies adjust their prices, they raise their prices to account for rising costs, which makes January's inflation look a lot higher. And then as the year progresses, inflation becomes a lot better. So we don't know which factor is going to dominate as 2025 progresses. It's going to be the January effect, which is good news for investors because inflation, then it would be a spike in Jan and then would moderate going in the months coming forward, or whether it is President Trump's tariff plans, which are going to dominate 2025, which could then continue to put unwanted pressure on inflation, thereby causing concern among investors. Speaking of tariffs, there were plenty of tariff-related news last week. Plenty. I mean, you could take the prime financial, news articles. You could take Twitter, or X as it's called right now. You could look at any social media, and it's all tariff. Plenty of news. All of which, by the way, all of these tariff-related news, if they come into fruition, have the potential to spike up inflation in the coming months. First, you had the 25% tariffs on imported steel and aluminum. Then on Thursday, President Trump signed an order that tasked his administration with investigating current trade relations and proposing reciprocal tariffs on a country-specific basis. Reciprocal tariffs are more likely to be the 2025's buzzword, by the way. And it's not good for inflation and it's not good for investors if it becomes a buzzword, but it has all the potential of becoming a buzzword. President Trump's fair and reciprocal plan will allow several agencies to investigate current trade relations and propose tit-for-tat tariffs on a country-specific basis. President Trump also said that countries charging a value-added tax would be likened to a tariff. I mean, obviously, as you know, value-added tax, VAT, it's a type of consumption tax that is levied on the incremental increase in value of a good or service at each stage of the supply chain. And President Trump says value-added taxes are also going to be likened to a tariff, and he's now sent an order to his various agencies to basically see how this concept of reciprocal tariffs would look and what structure or shape or form it would take and which countries are more likely to be affected. These are all in the works, by the way. Nothing's concrete yet, but however, these tariffs, should they go into fruition, is only likely to put pressure on inflation. Now, they're expected to make tariff very harder to bear. Now, there was a very interesting article on Wall Street Journal by one of my favorite journalists, actually, Greg Ip. He runs Capital Account. Capital Account is kind of a segment on Wall Street Journal. And the article was titled, "Inflation Helped Trump Get Elected. Now It's His Problem." Now, it's a very interesting article. I would urge you guys to read it. In the article, Greg argues that despite blaming the previous Biden administration for the current inflationary environment, rightfully so, in my opinion, President Trump's policies, such as higher tariffs and tax cuts, risk exacerbating the issue, making it harder to bring inflation down. In the article, Greg also outlines the tariffs of 25% on steel and aluminum imports and reciprocal tariffs on other goods could increase inflation by zero point 0.3 to zero point 0.6 percentage points. And the tariffs have already led to higher steel and copper prices in the United States. Now, speaking of steel and aluminum tariffs, you see how it's all connected, yeah? Steel and aluminum tariffs, they're already implemented. They've already come into effect. They are also likely to negatively impact yet another inflation component, which is auto insurance. Now, the tariffs on steel, aluminum, semiconductors, and auto parts from Canada, Mexico, and China are increasing the cost of vehicles again. I mean, you look at what Ford CEO Jim Farley had to say last week, and you'd probably say it calls it a lot of chaos in cost and so on. You can see the auto executives are already starting to voice their frustrations. Now, Ford is a company I'm not particularly a big fan of, given I think they're going in the different direction compared to their peer GM. So I'm not going to take Mr. Farley's words completely. I am going to take Mr. Farley's words with a bit of pinch of salt, because I think it's a distraction tactic more than anything. They had a horrible quarter as well. But one thing's for sure, it is the auto insurance, the component of inflation, is likely to be negatively impacted. Now, what has happened is the tariffs on steel, aluminum, and semiconductors, like I said, increases the cost of vehicle repairs, which in turn raises claims costs for insurers and ultimately leads to higher car insurance premium. Now, car insurance costs were one of the main components that drove January's inflation. They rose 11.8% year over year, up from 11.3% in December. So there was a marginal increase in auto insurance costs. Now, motor vehicle repair costs also increased by 7.4% year over year in January. Now, what these cost surges reflect is that they reflect the delayed effect of higher claims expenses on insurance pricing. An industry study estimated that the steel and aluminum tariffs could add over $7 billion to personal auto insurers' claims costs if tariffs reach 25% for Canada and Mexico and 10% in China. Even modest tariffs could increase the replacement cost by up to 7.7 percentage point above inflation within 2 years. So, what I would say is, in addition to the housing and rental costs, investors should keep an eye out for auto insurance costs as well, given the fact that your tariffs on steel and aluminum are already in effect and they're already causing price rises in the US. So a lot of negativity, isn't it? So if one could say all developments that took place last week, major, I've already talked to you about. Inflation report hotter than expected, your multiple tariff related news, again adding to inflationary pressures, geopolitical tensions don't seem to subside. But if you really look at last week, it's all negative, isn't it? There's a lot of negative bias. And yet markets had a euphoric week. NASDAQ 2.6%, S&P 500 1.5%, Dow Jones 0.5%. So what is this? Why is this disconnect happening? To understand this disconnect, actually you only need to look at two things, okay? One, you need to look at the fine print of Thursday's producer price index report, not CPI, but PPI report, as well as the Q4 earnings performance of US companies. Now, the PPI inflation data showed weaker than anticipated price increases, signaling easing inflationary pressures in the economy. And this particular, the weaker than anticipated price increases were seen in components that actually have a direct effect on the PCE metric. Remember the personal consumption expenditure metric, which is the Fed's preferred inflation gauge. The components that contribute to PCE are the ones that saw weaker than expected increase. And this is why the market was ready to shrug off the CPI. Remember, after the CPI print, the market had a down day, but then it made up once the PPI report came back, was published on Thursday. So in a sense, what the market's betting right now is the fact that, okay, CPI is bad, but the Fed's preferred inflation metric, which you get at the end of the month, could be, could have a silver lining, and could be coming in a lot cooler than what the CPI print indicates. So that is exactly one of the main reasons why you see this disconnect. Hotter CPI print, tariff news, all of that, the markets were willing to shrug off. And then, if you look at the Q4 earnings so far, they have been absolutely rock solid, more than offsetting any economic headwinds that have been hitting the US economy. Till date, the Q4 earnings growth stands at 15.3% year over year. That's right, 15.3%. A remarkable feat, given the fact that the companies had to go through geopolitical tensions and other macro headwinds during this particular quarter. It was one, to me, more than the PPI. I feel like it was the Q4 earnings growth of 15.3% that is the primary reason why the markets have so far shrugged off anything that has been thrown at them. Hotter than expected inflation, negative, any potential negative impact on tariffs from President Trump, and so on and so forth. And with respect to tariffs themselves, we still don't know how they're going to transpire. Markets, for instance, cheered that President Trump did not immediately put into effect the tit for tat reciprocal tariffs. And given the breathing rooms that countries have before these reciprocal tariffs go into effect, deals are there to be made. I think it's about a couple of months remaining before they go into effect. And so deals are there to be made, which is a silver lining for market sentiment. As far as investors are concerned, President Trump is a deal maker, loves to do deals, and this could leave, this could make for the final tit for tat tariffs coming in much better, or much better from a market standpoint than initially feared. At least it's the bet that markets are making, and this is another reason why you saw euphoria in the US markets in the week gone by. Bottom line, last week was a very stern test for market sentiment, thanks to a combination of hotter than expected inflation report and a plethora of tariff related announcements. Yet, markets shrugged off any negative news and plowed ahead. To me, this is all happening because of strong digit earnings growth that companies have delivered in Q4, and also a little bit of little parts such as the PPI component and little parts that the deals to be made, and so on and so forth that I said. But primary driver has to be the 15.3% year-over-year earnings growth that we saw in Q4. Does that mean that investors like you and I, who have put money in the US markets, do we need to be worried? I mean, do we need to be worried, or do we need to relax? Of course, I don't think this is the time to relax at all. Once the tariff picture becomes clear, there is absolutely every reason that the picture could shift dramatically. Once the tariffs, the whole concept of tariffs, what is the final amount, which countries are affected, which sectors are going to be affected, all of that, then it has all the reasons. I mean, it has all the all the fuel to basically dramatically reshape the full picture, the full market picture. As such, I wouldn't relax if I were you. At the same time, the Fed's stance on monetary policy is unlikely to change, given the latest developments we see in the inflation inflation area. And what is the stance? The stance is that there is no rush to cut rates. Chair Powell was in front of both the House and the Senate last week. He said the same thing. There is absolutely no reason for the Fed to cut rates. The Fed minutes that we will receive this Wednesday are likely to confirm this, along with the same moderately hawkish tone that Federal Reserve, Fed Chair Jerome Powell and company have been maintaining. I've repeatedly told you this, guys, and I'm going to end the segment with this. I've repeatedly told you that with President Trump at the helm, volatility is the name of the game. Given what transpired this last week, given the fact that negative news, good markets go up, and a couple of weeks back, good news markets go down, I don't see any reason to change the stance. On that note, let's go from US to India. As I welcome you to the next segment, the doctor goes home, where we did get inflation report, but completely different from what we saw in the US. Now, all I will say before I go into the inflation report is I'm going to start the segment off by saying the Reserve Bank of India's Monetary Policy Committee, which is in charge of dealing with interest rates, must have thanked their stars last week. That's all I'll say. As the latest inflation data coming out from India not only justified their first rate cut, but also offered room for more rate cuts in order to boost growth. And that's exactly what the RBI wanted, and that's exactly what the RBI got. In fact, it got more than what it asked for, if you really ask me. Before I get into details of all of this and what the latest inflation data means for both the RBI and India's growth story, let's start with the specifics of January's inflation report. India's retail inflation eased to 4.31% in Jan 2025. The decline follows a peak of 6.2% in October 2024, which was driven by high food inflation, which at the time stood at 10.9%. The actual inflation came in much better than what economists were predicting or expecting, which the prediction was that inflation would fall to 4.6%. It fell to 4.3%, a much better scenario when you really compare to the US, right? The primary driver behind the cooling inflation was food prices. I mean, is it any surprise at this point? I don't think so. I mean, I've been telling you every time I discussed India's inflation report, I've been telling you it's food prices, guys. It's food prices. It's food prices. So once the food prices go down, surprise, surprise, inflation goes down as well. So food prices basically eased to 6.02% in January, and they were at 8.4% in December. So significant, dramatic decline. The figure is the lowest since August 2024, which is absolutely welcome news given that food prices constitute nearly half of the CPI basket. Vegetable prices, which have been causing so much pain to Indian consumers in recent months, also came down dramatically, rising 11.35% year over year in January, compared with a whopping 26.6% year over year in December. Yes, vegetable prices still clocked double-digit growth, clocked another month of double-digit growth on a year-over-year basis, but the dramatic decline from 26.6 to 11.3%, I will take it any day. I'm not going to complain too much. Yeah, it's a welcome sign for sure, for absolute, it should make investors, should make economists, it should make RBI, everyone very happy. I don't care whether it's double digit. I like the fact it went from 26.6 to 11.3. Needless to say, cooling vegetable prices played a significant role in the moderation in food prices, along with a fresh winter produce and a healthy Kharif harvest. So all of this contributed to moderating food prices, which subsequently brought the inflation down. Both rural and urban areas saw cooling inflation, a very, very important development there. The rural inflation actually cooled to 4.64% in January from 5.76 in December, whereas urban inflation cooled to 3.87% in January compared to 4.6% in December. The latest inflation data was welcome news to the RBI and its new governor, Sanjay Malhotra. The central bank had finally kickstarted its own rate cutting cycle recently by undertaking a 25 basis point cut, less dramatic than the Fed. Remember when the Fed decided to start its rate cutting cycle, it went for a full guns 50 basis point cut followed by 25. RBI was slow, but a rate cut is a rate cut, and I'm glad that they did 25 basis point cut, which brought the repo rate down to 6.25%. And it basically reflected a shift towards addressing slowing economic growth. Now, while inflation continues to remain above the RBI's target of 4%, the fact that inflation is closer to 4%, 4.3% in January compared to December, and the fact that inflation is well within the RBI's target range of 2 to 6%. Remember, 2 to 6% is what we go for normally, and 4.3 is well within that. It should give the central bank more motivation to continue with its rate cutting cycle as it attempts to back a growth-friendly fiscal policy in the form of Budget 2025 with its own growth-friendly monetary policy. Governor Sanjay Malhotra projected inflation for FY 25-26 at 4.2%, with quarterly forecasts ranging from 3.8 to 4.5%. Investors also received some very positive news last week, as according to a report by Centrum Institutional Research, India's inflation is expected to average about 4.8% in 2025, with the recent decline seen in January's CPI print opening up the possibility for further monetary easing by RBI, something I've been telling you, I told you at the start of the segment. While the actual inflation figure that is given by the Centrum Institutional Research is slightly higher than RBI's own inflation forecast, the report highlights that as fresh vegetables and pulses continue to enter the market, inflationary pressures are likely to ease further. This trend, according to this particular report, provides the RBI with room for another potential 25 basis point rate cut, especially once inflation concerns subside. And I completely back the findings of this report. I really think that the RBI is going to continue with its rate cut cycle. I think at the next meeting, we will see another 25 basis point. And if inflation stays this way, maybe another 25 consecutive 25s in the coming meetings. I really do think that they're going to follow the same path as Fed, just not as big bang as what the Fed did. But all dependent on how inflation takes its shape. But it's much needed, guys, given the fact that India is going through a period of slowing growth or tepid growth. right? And especially after the Indian economy has seen a lackluster, disappointing earnings season, complete contrast to what you saw in the US. So very much a rate cut cycle, a sustained period of rate cuts is very much needed at this point in time. The RBI also offered some much needed relief to the banks last week by postponing the implementation of stricter liquidity and provisioning regulations, which actually provided some relief for the banks. The measures, which included new liquidity coverage ratio rules and enhanced provisioning requirements for project finance and stressed assets, will not take place before March 2026. The delay is intended to ensure a smooth transition and minimize disruption to the financial system. The delay also allows banks more time to prepare for these changes without immediate pressure on capital or profitability. It also frees up liquidity for lending and growth while avoiding disruptions in project finance or digital banking operations. It was yet another lever that the Reserve Bank of India pulled in order to ensure that economic growth props up. So I think this was yet another. Sometimes, it's good that RBI keeps its finger on the button when it comes to banking regulations. But given the time that more lending really needs to occur, and it really needs to drive private consumption, and it really needs India Inc. Needs this additional liquidity that the banks can provide to really turbocharge the capex spend, and which drives the cycle of private consumption, which then drives the growth. I think this is move by the Reserve Bank of India is it's a master stroke in my opinion. All in all, when you combine the budget 2025 measures along with RBI's latest moves and then factor in external tailwinds such as cooling inflation, then as investors, you've got to be optimistic about the Indian economy's long-term growth prospects. Business leaders are already seeing signs of consumption recovery. The FMCG sector, for instance, has already seen a consumption revival for the April to June period, and industries or sectors are also reviewing their capacity utilization plans, which indicates a potential revival in consumption-driven demand cycles. However, not everything is hunky-dory yet, and one could see continued volatility in the near term. As I mentioned earlier, the earnings season has been anything but rosy. Then you have the foreign institutional investors, or FIIs, who just can't stop selling their shares. Last Tuesday, for instance, the Sensex crashed 1,000 points in a single day as FIIs accelerated their exit from the Indian markets. And one can attribute this to the broader emerging market, quit emerging markets movement, which has been fueled by a higher US dollar, high US bond yields, and the excessive valuations of stocks in the Indian markets make the Indian stock markets a very easy target. At the same time, I've already mentioned President Trump's tariffs plans in the previous segment. I'm going to mention it again here because it is relevant. You have President Trump's aggressive trade policies. Ahead of his meeting with Prime Minister Narendra Modi and ahead of his announcement of reciprocal tariffs, President Trump singled out India as having the highest tariffs among countries, making it a significant target for these reciprocal measures. This could disproportionately impact India's trade with the US. The good news was that the talks between PM Modi and President Trump went well, and there were signs that the two countries could sign a trade agreement in the coming months. Should such an agreement become a reality, and should India somewhat manage to escape from the reciprocal tariff unscathed, then it could bring the FIIs back into the picture once again. Short term, though, I would expect there to be significant volatility in the Indian markets. Long term, however, given both the fiscal and monetary policies are working in tandem to revive India's growth story, and given that inflation is once again heading in the right direction, I continue to remain optimistic. You know me, you know by now, 115 episodes in, I'm a perma bull when it comes to Indian growth story. I continue to remain optimistic on the Indian growth story. That has not changed. And I'm just going to wrap the segment by saying, in my opinion, so should you. And with that, let's move to the final segment, Dr. Dissects, where yet another banking name goes in under the microscope this time. The stock is actually making a comeback after a long, long time. In fact, it made its debut appearance in this segment way back in episode 10. And we are in episode 115 right now. So episode 10 is when when this stock made its debut. So it's a long time, but better late than never, as they say. I'm talking about the investment banking giant Goldman Sachs, guys, ticker symbol GS. Yeah. Goldman Sachs, like JP Morgan, announced its Q4 numbers around mid-January, and like many of its peers, it had a strong finish to the year. Q4 revenues came in at $13.87 billion, up 22.5% year over year, beating analyst estimates by $1.41 billion. EPS in Q4 more than doubled, coming in at $11.95, surging past analyst estimates by $3.66. The bank's book value per share for the full year came in at 336.77, registering a growth of 7.4%. The company continued to demonstrate its superiority in mergers and acquisitions, finishing the year once again as the number one player, both with respect to announced and completed M&A transactions. Its asset and wealth management arm also finished the year on a very strong footing, with assets under supervision reaching a record $3.14 trillion. The division also ended the year with record management and other fees, as well as record private banking and lending net revenues. All in all, the bank in 2024 generated return on equity of 12.7% and returns on tangible equity (ROTE) of 13.5% compared to 7.5% and 8.1% respectively in 2023. That's not what I'm here to talk about. I'm here to talk about the major developments that we saw, not just in the quarter, but in recent times when it comes to Goldman Sachs. Remember, it's not just numbers, it's about what investors should expect, right? Is there a driver? Is there a catalyst? Is there something good for these stocks? Now, 2 days prior to its blockbuster earnings report, Goldman Sachs had already laid out its long-term intentions, which was to be one of the biggest players in the world of financing. This was very evident when the bank announced that it was bringing the three groups from its global banking and markets division under one umbrella and calling it the Capital Solutions Group, or CSG. Not ESG, CSG. The three group, ESG is a taboo term in the US. So right now, so cut. CSG, yeah, Capital Solutions Group. The three groups include the Financial Sponsors Team, which offers investment banking services to private equity firms, the Global Financing Group that aims to find investors who can provide capital for deals, and the FICC Financing Team, which makes loans that are tied to collateral to other lenders. The intention behind the creation of this new division is very, very clear: to capitalize on the surging popularity of private credit and the expected ramp up in private equity deal making. In my opinion, Goldman Sachs has got this decision absolutely spot on, and here's why. Private credit is expected to surge to $2.6 trillion by 2029 from roughly $1.5 trillion at the start of 2024, so nearly doubling in 5 years, and more than doubling from $1 trillion in 2020, according to Prekin. And banks' exposure to private credit has been ramping up very steadily. According to Moody's research, bank loan commitments by the end of 2023 reached $525 billion, which translates to an annual growth of 18% on average from 2021. If you compare this with overall lending, which grew at an annualized rate of 6% during the same period, and one could clearly see that banks are seeing the growth potential of private credit to be much stronger compared to other lending activities. Goldman Sachs, through its alternatives platform, already has approximately $145 billion in private credit. This suggests that the potential for market share gains for Goldman Sachs is huge. As such, the timing of the restructure comes at the right time, in my opinion, and being the leader in M&A should help with this initiative. In addition to private credit, the other benefit of the structure is that it would allow Goldman Sachs to focus on private equity deal making with a higher degree of focus. The new Trump administration is expected to loosen the grip on M&A regulation. And as I mentioned when I talked about JP Morgan, according to JP Morgan last week, check out last episode for my take on JP Morgan. According to Prekin, private equity firms were expected to close out 2024 with $1.6 trillion in the so-called dry powder, which means cash that's yet to be released or that's yet to be unleashed. Moreover, the pressure is on for private equity firms to deploy this cash as investors expect these firms to demonstrate differentiated earnings growth. 2024 was a relatively good year for private equity deal making, accounting for 24% of the total global M&A value compared to 21% in 2023. Despite this marginal uptick, the overall private equity-backed deal volume was still down 29% for the year, which suggests that there is a lot of catching up to do. This is yet another avenue for Goldman Sachs to capitalize on, especially given its status as an M&A advisory. The new restructured group should help the company to achieve this goal. Overall, FY24 was a fantastic year for Goldman Sachs as M&A made a comeback. With a new administration in place, one that favors more deal making and one that has promised to ease regulations, the growth in deal making is expected to spill over into FY25 as well. Private equity companies are expected to be at the forefront of this given the amount of dry powder that they have. As such, banks who cater to these companies are expected to capitalize on the M&A boom. Goldman Sachs already achieved this in 2024 with a new structure in place, one that makes catering to private equity a priority. I expect the M&A leader to pull further away from its peers in the coming year. I'm going to go back for a bit. I'm going to take my book. I'm going to take my pen. It can only mean one thing. It can only mean one thing. You see some figures here, valuation. So let's talk about valuation, guys. All right. According to LSEG data, just want to check my, oh, we're doing well. I was just checking my battery. I don't want to go. According to bang, no. So according to LSEG data, Goldman Sachs currently, right, let's put what company are we tracking this week? It's Goldman Sachs. So GS currently trades at a forward price to book multiple of 1.82x. Okay. Goldman Sachs forward price to book 1.82x, which makes it the third most expensive among its peers behind Morgan Stanley and JP Morgan. Goldman Sachs is also more expensive on a historical basis, with its historical forward price to book being 1.1. I laugh because 1.8, 1.1, clearly there's a re-rating here. However, given the deal environment is expected to pick up in the coming year, and with Goldman Sachs being the leader in M&A, and given that private credit sector is expected to grow exponentially in the coming years, I think Goldman Sachs has deserved this re-rating that has been given to it by the market. However, the year-over-year growth in its FY24 book value lags behind JP Morgan, and with respect to 2024 return on equity, Goldman Sachs lags behind both JP Morgan and Morgan Stanley. As such, a forward price to book multiple lower than both Morgan Stanley and JP Morgan is reasonable in my opinion, and as such, I've assumed a forward price to book of 1.82. Now, according to LSEG data, the company has beaten analyst estimates of tangible book value per share in 4 of the last 5 fiscal years. As mentioned earlier, as I talked about it this earlier, Goldman Sachs is entering an environment that is favorable for both M&A environment and M&A deal making and private credit. As such, I would expect Goldman Sachs to beat the analyst estimates again. On average, the magnitude of the beat was 0.53%. The analyst consensus of Goldman Sachs FY25 tangible book value per share, so for the analysts is 338.86. Okay, 338.86. Now, let's say it beats by it beats by 0.53%. This would make my projected FY25 tangible book value per share would be 340.66. Okay, so 340.66 is the projected tangible book share. Analysts put it as 338.9, 0.53% gain. So that would be 340.66. Now, a forward price to book of 1.82. Multiply that by 340.66 and you get a price target of 620. Okay, 1.82 multiplied by 340.66, you get a price target of 620, which suggests that Goldman Sachs is about 6%, 7% overvalued at current levels. But despite being marginally overvalued in the short term, I simply expect the stock to still go up. And this is because it has very strong momentum, just like JP Morgan, especially post its earnings release. It has an A grade on Seeking Alpha's momentum scale, same grade as JP Morgan. The financials have been off to a blinder here in FY25, in 2025, and I expect the rally to continue. So it could be an excellent momentum play. Goldman Sachs could be an excellent momentum play for the short term. In the long term, from a fundamentals perspective, I don't see current levels as a good entry point if you're an investor. If you're a trader, sure, you can play the momentum play. But as an investor, long-term investor, I just don't see, I would expect some pullback. I would wait for a pullback before initiating a position. As such, my rating is a hold. This is the price target and a rating is the hold. So price target of 620, hold is my rating. Bottom line, ladies and gentlemen, we're coming to the end of the show. Goldman Sachs had a phenomenal finish to the year. Like many of its banking peers, profits more than doubled. Both the top and bottom lines comfortably beat analyst estimates. The banking giant's return on equity significantly improved compared to last year as the company renewed its focus on its strength rather than chasing new areas of potential growth. Going forward, the company's new capital solutions group is expected to be a game changer, in my opinion. The growth in private credit has surged exponentially, and banks are capitalizing on it. With a robust private credit portfolio already, the new division has all the tools required to capitalize on this growth. Furthermore, the M&A landscape is projected to continue its upward trend in FY25 now that the new Trump administration is in place. And private equity companies are expected to play a much bigger role in deal making in the coming years. Given that Goldman Sachs new division, the CSG, focuses on both these growth levers, which is private credit and private equity deal making, the long-term growth story remains firmly intact. As such, any meaningful pullback in the name should be treated as an excellent buying opportunity. That's all the time I have for you this week. My goodness, time really does fly. We've come to the end of yet another episode. If you have a specific Indian or US stock suggestion for the doctor to diagnose or dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening, guys. I hope I will try my best to put in yet another 7 p.m. show next Sunday. As things stand, it is due to go live again at 7 p.m. today, this episode, and the next week also, we're back to our 7 p.m. routine. So see you next week, whatever happens. Until then, stay safe and make some money.